Hello, oracles. Is the stock market wrong again? We've been talking about this for the last couple of months now. Actually, I've been kind of talking about this for the last couple of years. We had Adam on a few years ago discussing how the market usually reacts when the Fed raises rates, when the Fed pauses rates, and when the Fed cuts rates, and how the stock market reacts. And it's usually lagging indications and then leading indications for other things. So today we're going to discuss, is this time different, or is the stock market wrong again? Now, before we get into this, if you guys could do me a favor, please hit that like button down below, subscribe to the channel, really helps the channel grow. So, looking into all of this, thinking about what I've been discussing for a little while now about when the Fed raises rates, we saw what happened in 2022. The market typically crashes down, Fed's raising rates. It's not good for high growth stocks because you're contracting all of the money supply. You're shrinking that M2 money supply, less money, less room for growth. That's really how it goes. And then when the Fed pauses rates, what ends up happening is you see the market melt up. The market just goes and keeps on making all new highs as the Fed has paused rates because they're anticipating that rate cut and they're trying to lead ahead before we get those rate cuts. And that's exactly what we saw transpire as soon as the Fed paused those rates. And there was a little bit of a delay for it, but it's because we saw the last rate hike in July and the Fed never gave us true indication of a pause until we got till about the October-November timeframe of 2023. Then at that time, very end of October of 2023, we saw the market climbing up from there. And then when the Fed gave us that clear indication in December that we were going to be having paused rates, the market continued to climb from there. We never really saw a pullback in February. We saw a little bit of a 7% correction in the March-April timeframe, but like that was really it. Since then, we've basically been up. And then we had the August 5th pullback. But realistically, that's really all we've had all year. And then historically, when we see the Fed cut rates, we would see the market. Typically, you would think fundamentally with the Fed cutting rates, you would want to see small caps and growth stocks go up because the rates are getting cut. And historically, you do see that for a very short period of time, and then the market comes down afterwards. And it's not a correlation between the Fed cutting rates and the market coming down. What ends up happening, the correlation is because the Fed cuts rates because of some underlying fundamentals going on in the economy that they need to compensate for. And that is why the market ends up selling off massively. The problem is between the Fed cutting those rates and the market pulling down, we don't know what those underlying pieces are. It's usually kind of hidden and masked until something actually breaks for certain. And so, of course, as we know in 2007, that was the entire housing market. There was a bubble going on a house of cards, and it ended up collapsing. So this time around, we don't have, as far as we know, anything going on with the housing market like that. But we do have massive credit issues when it comes to consumers that are out there. We are also seeing unemployment going up and ticking up higher and higher. And it seems like, based upon the Fed minutes that we got today, that the unemployment is a major concern of the Fed. And the Fed, in their minutes, has discussed how once that unemployment starts to move along, it is very hard to stop it. So I think that's why they ended up going with that 50 basis point cut, because they're trying to get ahead of this to actually catch that before we see runaway unemployment. Now, historically, when you've seen unemployment go up by 1%, it always goes up by another percent afterwards. And it's relatively quick getting to that point. And don't forget that unemployment is a massive lagging indicator. We get that data very late as far as what it goes. And like a lot of these issues have already transpired by the time we get the data to say, yeah, you've had those issues. And so, yes, we have seen unemployment this time show that it came down. But when you dig deeper into the report, you can see that the seasonally adjusted number was 785,000 jobs from the government. That's kind of concerning because they did take the teachers' pieces out of it. So you assume teachers going back to work. So you want to take that piece out. But how many government jobs are there out there? And you guys can let me know in the comments below. I want to hear from you. Do you know anybody from a government job that was maybe laid off over the summer and went back to work seasonally? What seasonal government jobs are out there? You know, you can say, well, FEMA going to work for the hurricane, but not 785,000 of them. So I'm really curious, and you guys can let me know again where these 785,000 jobs are coming from. And I have a feeling it's going to get revised down. Now, when you run the numbers on that, if you remove just half of those, unemployment actually went up. So is this a number that we got floating because of election time? Was this a number that we got floated because we don't want to scare the market and cause a massive recession or a market crash right now? Are we trying to kick that can down the road to try and salvage things and maybe be able to get a better number coming out next month and push things along to kind of get that soft landing? I don't know. And I don't know what the actual answer is to any of those questions. Again, you can let me know your thoughts in the comments, but it's kind of concerning because that is an astronomical number that we have never seen before. So it's not like this is a normal, hey, seasonal government jobs. Maybe we get a 500,000 or something every single year this time of year. That doesn't happen. So where did these jobs come from? Why did we see that number? Now, when it comes to government jobs themselves, if we did truly get that number, that's awesome. Hey, I love to see that many people get employed. But here's my concern about government jobs. In running retail businesses myself, there's two different sides of the coin when it comes to employment. You've got the people who bring in money, and then you've got operations, and those are high labor costs that don't actually bring in money, but they can create efficiency within the company, and they're just necessary jobs that have to be there to help the company run. But you want to keep those costs as low as possible because if you can automate any of those jobs, you want to automate them because, again, that's payroll that is not actually bringing in money for you. When it comes to government jobs, most of them, about 99% of government jobs are like operational costs. Those jobs are not bringing in money. Those jobs are costing the government money. So this is why a lot of times when you hear people talking about smaller government, it's because that's a huge expense, all those jobs. And again, it's great to have people being employed, but if you have an entire market that is employed by only people that are costing money and you don't have as many jobs bringing in money, then how do you pay for those jobs that are costing you money? That's the problem. And this is why you've got the two different sides of the coin. And typically, the stock market and businesses and corporations and all that, those are the ones that are bringing in money because they're the ones who are paying taxes to cover the cost of those jobs that are in the government. So now, if you're at a point right now where all the jobs you're bringing in are government jobs, cool, you've got those new jobs, but you are now losing a lot of jobs that are bringing in money. So, how do you pay for those jobs that are costing you money? That to me is a major concern. So, I really want to see these numbers going forward and track what's going on because, again, when you start looking historically as what is that trigger point that has caused the market to crash? Why did the Fed cut rates the way they did if supposedly the economy is looking good? What are the underlying pieces that they're not telling us right now? Is it the unemployment? Because based upon the minutes, it seems like it's an unemployment problem. So then when it comes to the unemployment problem, again, the question is are the numbers we just got that seem to be good actually good? So I truly don't know the answer. And I've said it before and I'll say it again. I hope we do get that soft landing. I hope the Fed is able to pull this off. But there's so many underlying indicators that are really telling me that it's not going to happen. And the problem is they've now kicked this can down the road, which seems like we may end up getting, which based upon what we saw in 2007 is when the Fed cut rates, we saw the market run for about 6 to 8 weeks. And then we saw it trade a little bit sideways with kind of that uncertainty. And then beginning of the year, we just saw that it coming crashing straight down. I'm kind of concerned that that might be the timing of what we see playing out. The Fed may have kicked the can down the road for the next 3 months or so. We get through election, we kind of get to that holiday season, but then we start getting those early holiday numbers and you're like, oh, those holiday spending numbers weren't as good as we were hoping they were going to be. Then we get the actual numbers in January. We got unemployment numbers in January. The hiring during holiday season wasn't as strong as it normally is. The sales weren't as strong as they normally are. Then you get all those layoffs from those holiday jobs. Unemployment goes up even higher in January. And then February, those numbers come in for January with all those layoffs, and it can get pretty darn ugly really fast. So these are just the concerns I have. Now, again, as I had mentioned the other day, I'm not just selling out of everything and stockpiling cash because I don't know. I still want to be invested in the stock market. Again, most people, historically, when you look at some people, they're like the dead man portfolios that are out there, and people who have passed away have done some of the best performances in the stock market because they didn't touch it. It's like a set it and forget it situation, which most people do with their 401k. And so, like going through the housing market crisis, when we went through all of that, people who had a 401k that they didn't do anything with actually did very well because they dollar cost averaged right through that as the market was down at its very lows. And that's kind of how I set up my portfolio itself is I have a huge cash stream coming in and I don't drip most of it. So this way I have cash coming in and I have my cash pile of 9%, which will be growing to 10% very soon to be able to just be ready to take advantage of these opportunities. My portfolio right now is just over $55,000. So let's say, for instance, that portfolio grows to $60,000 by the time we hit maybe a crash coming in February or March. So if I'm at $60,000 at that point and I have 10% cash, that's $6,000 in cash. If the market pulls back 50%, I will be deploying $3,000 worth of that cash into the stock market and then still have $3,000 left over with a $30,000 portfolio. Is that scary? Hell yeah. If I'm looking at my portfolio value coming down to 30,000, that's scary as hell. However, if I was not paying attention to my portfolio at all and this was all completely automated, that would be some of the best buying opportunities we could possibly be in. And I would have a giant chunk of cash being able to get deployed during those times to buy even lower. So again, it's one of those set it and forget it type of mentalities. And if you're actually paying attention to your portfolio, you have to train yourself to not panic sell, not panic about things that are going on. You don't know what the future is going to bring. You don't know if we are going to crash. And if we are, you don't know when it's going to happen. And if we do crash, you don't know where that bottom is going to be. But dollar cost averaging and just following a strategy going into it, sort of the catching the falling knife. But if that knife is going to end up coming back up and being strong and sharp on the other side, then it's not really that horrible catching that falling knife and you're actually buying at a lower price. So that's not financial advice. None of this ever is, but that's what my strategy is. And that is historically what has worked, especially when it comes to 401ks, dollar cost averaging. And that is why that is one of the best ways to grow your wealth over the long term, because trying to time the market fails more often than not. So that's just my thoughts about what's going on. So again, is the stock market wrong? And we are actually seeing a lot of underlying fundamental issues going on that the stock market doesn't see because they're just following what we think is going to be going on. And it seems like on the surface that we are going to get through this. Or does big money out there know what's going on? They see it all and they're intentionally driving the market up, manipulating it upward to try and squeeze out as many profits, enticing retail investors to get in because they think, hey, we are going to get a soft landing. The stock market's running. I don't want to miss out. I don't want to get FOMO, that fear of missing out. We're going to buy in. And then all of a sudden, boom, that rug gets pulled. Retail investors are bought in higher because big money has already bought in at a much lower price. They sell out, make their huge profits. Retail money loses their money. They start panic selling. And then as it's coming down, big money starts buying in again. So I don't know, and I don't know how all that plays out, but I do know factually that the stock market is manipulated by big money at times. So is this one of those cases? We do know factually, historically, that this has happened in 2007 and in other previous times when the Fed has cut rates. So these are things that we have seen before. So are they going to play out again? Again, nobody knows. That's why dollar cost averaging is going to be my strategy going through this. But again, I'm still invested. I only have 9% cash. I'm working up to 10% cash. And then after that, I'm going to be working on like little increments. At most, I'm going to get myself to 12.5% cash unless I see some other reasons to build up more than that. Or if the market is pulling down so fast that I just have way more than 10 or 12%. That's another case scenario in this. But again, I'm not looking to get a giant stockpile of cash. My portfolio isn't like in the millions of dollars where I'm concerned and want to make sure that I have, maybe $1 million sitting on the sidelines. I'm a smaller portfolio. So having, $5,000, $6,000 is perfectly fine for me. And I will just keep on deploying cash into this as we go through whatever is going to happen. So that's all I've got for you guys today. Please remember to hit that like button down below and subscribe to the channel. Thank you guys so much for watching. I appreciate all of your support. Have a great one.